Welcome to the Capital Markets Review for the third quarter of 2017. As always, my purpose here is to inform and to answer questions on the economy and the financial markets. This isn't meant to be a prediction for the course of the markets for the remainder of 2017. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, with their permission, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management, with additions from American funds and Raymond James for the simple ways they present complex ideas. Most slides have multiple charts on them. I will point out the information I think is most relevant. I will keep the narrative moving throughout the presentation, but feel free, obviously, to pause at any time to study slides more closely as needed. The opinions expressed are mine, and not necessarily those of Raymond James, and neither J.P. Morgan nor American funds are affiliated with Raymond James. This quarter, there are four main themes I want to stress. First, I'm going to start with an economic update, then I'll talk about interest rates, the equity markets, and finally what investors should be doing. While last year was a difficult time to be an American investor in overseas markets due to the rising dollar, this year, so far, has been the opposite. In the first half of this year, the S&P 500 has risen over 9%, and overseas investments have received a boost from a softening dollar by about 2.5% in the aggregate. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. There's another story here as well. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put their faith in unmanaged indices rather than in managed diversified portfolios. Despite recent experience, diversification is still important. Like it or not, America leads the world economically. When we fall into recession, the worlds tend to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. On the right, we're looking at the components of GDP. Consumption always makes up the largest chunk. Therefore, it's important as investors to know how consumers are doing financially. Overall, GDP growth remains low versus historical rates. These four sectors are considered to be the four horsemen of the apocalypse because they tend to lead into recession and also lead out. There are signs of concern on the right, but the charts are related. The top right shows that inventories have risen, though now falling off their peak. Because of rising inventories, capital goods orders have slowed to allow inventories to fall again. The charts on the left deal with the consumer, and they are not signaling a recession, although there has been a slowdown in auto sales recently. Consumers can put off buying a car or finding a place to live for only so long. Eventually, both of these categories revert back to the mean. Higher home values help create a wealth effect for consumers. Nothing makes consumers feel wealthier and freer to spend money than having their largest asset class appreciate in value. Home values have been on a solid growth trajectory since 2012, and housing affordability remains strong. Note the bottom left chart, though. There was a significant uptick in mortgage lending rates in the last quarter of last year. No market indicator will remain at extremes forever. Mortgage rates will revert to their long-term mean values eventually. This will increase the housing affordability index as well, as homes become more difficult to afford for the average buyer. The growth in global oil production since 2013 came almost exclusively from the United States. While global production increased by 6%, global consumption only increased by 3.8%. The combination in the change of the supply-demand equation with the accompanied derivative products explains the rapid drop in the price of oil. We have recently moved from a position of parity between supply and demand to future projections of surpluses. In the long term, that should keep the price of oil low. Note the chart in the bottom left. The drop in the price of oil, with increased inventories, brought about the idling of 2/3 of oil rigs in the U.S. The higher price of oil has made it more economical to reopen some oil rigs. Because of this, oil will likely remain banded below $60 a barrel. In the longer term, the price will likely rise as demand continues to grow at a historical rate of 1.4%, while supplies seek equilibrium. Demand will be driven by economic growth, while supply can be somewhat controlled by oil producers. Generally, when unemployment falls, job prospects have greater leverage in negotiations. This tends to drive up wages. In this economic expansion, wages remain lackluster despite a significant fall in the official unemployment rate. This shows the softness of the real jobs market. One way we can measure the true level of unemployment is to consider the labor force participation rate. This shows the percentage of the working age population participating in the labor markets. At around 63%, we are at levels not seen since the mid-1970s, as reported by multiple media outlets. As the economy strengthens, the recent trend has arrested its descent. Some of the drop in the participation rate is attributable to people leaving the labor force due to aging. Consumer balance sheets are very strong in the aggregate. Total assets have reached new highs, while liabilities are very low. In fact, the amount that debts are costing households as a percentage of disposable income remains at extreme historic lows. Another thing to consider for the consumer is the fact that after 7 years, bad debts fall off of credit reports. Access to credit adds fuel to consumer fires. We are beyond the 7-year point from 2008. Consumers have greater access to credit and more spending power than they have had in a decade. Another thing to note about this is that rising interest rates won't have a strong direct impact on consumers' balance sheets. 2/3 of their liabilities are fixed in mortgages, which won't be directly affected by rising interest rates. Since last quarter, assets have grown and liabilities are slightly higher. The federal government's finances have improved from the last number of years. At the peak, the federal government was borrowing more than 35 cents of every dollar spent. However, since last year, the borrowing rate has grown from a low of 12 cents of every dollar spent to 17 cents of every dollar now. The long-term forecast calls for borrowing levels to increase going forward, and at an increasing rate over recent quarters. This is a graph from a previous guide to the market showing corporate income tax rates in the world. The U.S. has the highest corporate tax rates in the developed world, and they have not changed in the last decade. This is one area where recent elections may have an impact. You may have heard of the Trump effect. What is it, and does it have a true weight in the economy? The Trump effect is the anticipated effect of promised policies primarily on the return of wealth from overseas and a reduction in tax rates. If an estimated $2.4 trillion in cash held by companies overseas were to be repatriated, it could improve S&P 500 earnings by 1 to 2.5%. Reducing the corporate tax rate to 25% could improve earnings another 3%. If corporate tax rates were reduced to 20%, it could improve earnings 6 to 7%. At his proposal, President Trump has proposed a 15% corporate income tax rate. This could be part of the art of the deal, which suggests that you should reach beyond your goal so you can negotiate back to your goal. We might end up in the 20 to 25% range. But if the corporate tax rates were to drop in the 15% range, then that would boost corporate earnings even more. Inflation remains very tame, well below the historical averages. However, there are areas of the economy with greater than average inflation rates. Unfortunately, some of the higher inflation items, like food, housing, and medical care, affect everyone, while some lower inflation items, like recreation and transportation, don't affect all economic participants equally. The future will likely see a return to more normal rates. If economic growth rates accelerate, higher inflation is likely to be one of the consequences, especially with an expanded money supply. Inflation assumptions can be a starting point for investment assumptions. Starting with low inflation and having it rise is a scenario we've seen 8 times since 1974. In this environment, equities and commodities have been the best performers, although I maintain the commodities number is skewed by the late 70s, but more on that later. Bonds and cash have not fared well in these environments. Let's talk about interest rates. After falling for the last 31 years, bond yields remain at historic lows. Bond investors likely didn't enjoy the last quarter of last year when interest rates rallied on a short period of time. Average nominal yields for the long term have been around 4%. This means that the nominal yield on the 10-year Treasury would have to rise around 2% just to get back to historical averages. The long-term outlook for interest rates is a rise toward the long-term averages. The movement of interest rates will impact bond investors as they watch the values fall. Falling bond values will also make bond holdings illiquid, as asset bids may not match realized results when sold. This is a dangerous environment for bond investors, as rising interest rates may counter coupon payments and remove the reward from the risk-reward equation. When interest rates return to their mean value, how much more can be lost in the bond markets? From current levels, a 1% rise in interest rates will see a 17.7% loss in 30-year Treasuries and an 8.4% loss for 10-year Treasuries. Those with significant bond holdings, especially Treasuries, should carefully consider their asset allocation. Among all bond categories, only convertibles, floating rates, and high-yield securities would see positive returns in this environment, and only because of their higher yields. Let's take a longer view of interest rate history, though. This chart also shows the 10-year Treasury, but it begins at 1870. The long-term view of interest rates shows that the recent low interest rates are not the anomaly. The high interest rates were. Although the 60-year average for 10-year Treasury rates works out to around 6%, history shows that rates tend to be banded around 4%. We are currently at historic low rates, but this environment could last much longer than most people expect or are ready for. Interest rates will likely recover toward the 4% range eventually. There's no reason to expect a rise to the double digits of the early 80s, though. Also consider that the low rates of 32 years were not inconsequential during those decades. About halfway through the period, rates began to rise and create havoc for bond investors. The Fed expects to continue on a path of raising Fed funds rate. The market disagrees. There is an element of uncertainty created in this environment where the market doesn't trust the Fed to follow through on its own program. What is driving rates higher? Since the U.S. has the highest short-term rates in the developed world, there is little pressure to raise them higher. This trend is also occurring in other developed countries where low rates are rising and negative rates are anticipated to return to positive rates. In general, Japan isn't expected to raise its rates for the long term. One telltale sign of impending recession is an inverted yield curve where short-term interest rates are higher than long-term rates. See the top chart. Despite flattening over the last 3.5 years, the yield curve remains positive, where short-term interest rates are below long-term interest rates. So let's talk about the equity markets. Between March 9th of 2009 and the end of June 2017, the S&P 500 increased by 258%, not counting dividends, and that's a huge increase. There's hardly a period of time that is shorter than the period of time between when a client thinks it's too early to get in and the market analysts think it's too late. Those with a short-term view of history would be forgiven for seeing a peak at these levels. Consider, though, that we've been through what's known as a secular bear market. There are really two phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 17.5. Although the recent number of 17.5 times earnings for forward PE ratios is a little above the 25-year average, it is not reaching toward extreme levels yet. It is still below one standard deviation from the 25-year average. Holding all other things static, earnings growth will lower the PE ratio, and we are expecting earnings to continue to grow. The question will be how quickly stock prices move, especially in relation to their earnings. We can look to history for a guide to what's possible. The last time PE ratios were at this level was the middle of 2003. From the middle of 2003 to the third quarter of 2007, PE ratios actually fell. Over about 4 years, PE ratios went from above average to back below average. Despite the reality of falling PE ratios during this period, the S&P 500 equity values actually rose over 13% on average per year. That rate is actually above the long-term averages. So going back to the earlier chart, this is what that mid-2003 to the third quarter of 2007 looked like to investors. Certainly, this wasn't a bad time to be an equity investor. The important thing to realize is that the PE ratio has two components, price and earnings. We tend to assume that the overall ratio is driven by price. When PE ratios are rising, markets must be rising. When they're falling, market values should be falling. The reality is that both factors are important. PE ratios fell from mid-2003 to the third quarter of 2007 because earnings rose faster than prices. The forecast going forward is that the recent earnings doldrums will end and earnings will begin rising robustly again. In this environment, equities have room to move higher without moving PE ratios to extreme valuations. In fact, you can see that recently the growth in earnings took a hiatus, and that's one of the reasons that the PE ratio has grown so high recently. The main reason to invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, earnings have picked up and have resumed their trek toward record levels. The drop in oil prices and the rising dollar have been the biggest stories in this area. Nearly half of S&P 500 revenues are derived from overseas sources. Energy companies, and peripherals to the energy industry, are obviously suffering with lower revenue from lower oil prices. Multinational corporations are also suffering as they repatriate earnings from overseas. Stabilizing the dollar and oil have made things look much better very quickly, and earnings are increasing. This chart shows secular bull markets and secular bears. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time will answer that question. However, strong market performance shouldn't deter stock investors with a broad view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. There are some rumblings that this bull market is too old and has been growing too long to continue. The reality is that There are some rumblings that this bull market is too old and has been growing too long to continue. The reality is that this bull market is neither the longest lived nor the highest flyer of post-World War II equity markets. The news is filled with sensationalism every time the equity markets hit a new high on the indices. Here's the reality. Anytime the market is currently at a high, it is likely to hit a new high on another day soon. New market highs are made from previous highs. Don't be discouraged when the press points out each new market high. They tend to purport sensationalism, and it sounds sensational to say the market reached a new high. But if it's at a high today, even an increase of 1 tomorrow is going to be a new high. This is actually a meaningless measure. We are in the fourth largest expansion since World War II. However, we are coming out of the deepest recession in the same time period with the weakest recovery. There is a lot of room for expansion with growth-oriented policies. The chart on the right shows an economy that has not been performing in line with historical averages. There is room for growth. As mentioned earlier, strength in the U.S. economy helps to bolster overseas economies. Overseas valuations are more attractive than domestic markets. Would you want to go back in time relative to the S&P 500 and invest at lower valuations? In a way, that's what's represented overseas. No investment is without risk, and this isn't a sure thing by any means. But the valuations are more attractive here than in domestic markets. Make sure your portfolio isn't too America-focused. The U.S. has once again taken the lead in the global economic earnings, as Europe and emerging markets have significantly retreated off of their highs. Another way to view the situation is that there is opportunity in overseas equities. Make sure to diversify equity portfolios across international borders as well as economic sectors. Trying to forecast the next bear market, let's look at past patterns. Bear markets generally occur in conjunction with economic recessions. They also tend to be in conjunction with the recessions and other factors such as a commodity shock, or the Fed is tightening aggressively, or there is extreme valuations. None of these conditions are prevalent in the current economy and markets. Few economists are forecasting a bear market for any other reason than it seems to be about time for one. There is a great deal of cash relative to GDP in the economy. The chart on the right shows that over $12 trillion remains on the sidelines in various cash equivalent accounts. There is another estimated $1 trillion in actual cash in our pockets, not represented in that number. This is nearly $4 trillion greater than normal. As confidence returns to investors, this is a great deal of potential energy. Also, the upper chart shows another stimulus for stocks: yield. Cash investors, CDs also, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make some money. The alternative to stock dividends is to take on interest rate risk in the bond markets. As shown earlier, that isn't a good long-term proposition in my opinion. When interest rates rise from below 5%, the result has universally been beneficial to stocks since 1963. The dots show weekly stock returns relative to interest rate movements. The historical equation benefits equities in this environment, even in the short term. This chart shows that the trend of falling global growth has been arrested and is now on the rise again, and this is a good sign for investors. So what should investors do? Well, first off, it takes courage to invest. Even though the market finished positive 75% of the years in the last 35, the average year saw an intra-year decline of 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor for long-term growth. Now, we would all love to be able to invest without risk. If I offered someone an investment which would have an average annual return greater than 7% a year, most people would jump at it. Well, that's what the red line looks like. What that line represents, though, is the average annual return of the S&P 500 for the 20 years that ended at the bottom of the fiscal crisis, or at the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in a portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of 50% in the S&P 500 to return to the 7% average line. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have seen even better results, and some of the unsuccessful ones have seen worse. In the commodity realm, consider the graph in the upper right. Those who bought gold at its peak in 1980 waited until 2007 to realize a positive return. When factoring for inflation, these investors have still not realized a positive return in real terms. Moreover, recent investors have seen a significant erosion of capital since its peak, greater than 1/3 of its value. Where is a good place for investment dollars in the sectors of the economy? Look at sectors the same way we earlier looked at asset classes, and you find a similar story. Those sectors you find on the top will one day be on the bottom, and vice versa. Note, for example, that last year's top sectors were energy, telecom, and financials. Near the bottom so far this year? Energy, telecom, and financials. Since the S&P 500 is comprised of companies in all of these sectors, you will always find it somewhere in the middle. This shows the power of diversification. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 2.3% on average for 20 years, the average investor has barely kept pace with inflation. In the more recent time frame, you see the same outperformance by equities despite the volatile markets. Investors had a more difficult time of it for sure. However, patience through the fiscal crisis to today has been rewarded. Those investors who did not have the stomach for equities and chose to sit in bonds or cash were more comfortable, but much less rewarded. In fact, if you were a cash person leading up to the end of to October of 2007, the peak of the market before the fiscal crisis, and noting the returns your friends were getting, you decided now it's time to finally get into the markets, and you went all in with all of your cash into the S&P 500 at the worst possible time, at the peak of the market before the fiscal crisis. 5 years later, you would have had a 2.5% average annual return. Meanwhile, sitting in cash, you would have had very little, if any, return at all. So even in that short period of time, the equity markets still prove their value even versus cash. It's important to recognize that the long term is important when dealing with equities. So here's another way to look at it. Over any 1-year period, almost any asset class may lead. Over any 5-year period, investors are generally rewarded for investing in equities. Over any 20-year period, there really is no comparison. So, short-term needs should be funded by investments in short-term assets like cash. Medium-term needs may be rewarded for investing predominantly equities, but using other asset classes to manage volatility. Long-term assets should have a very strong leaning toward equities. Diversification and asset allocation do not equal a profit. Diversification and asset allocation do not ensure a profit, nor protect fully against a loss. As I mentioned, the long term works to the advantage of equity investors. Those who can be patient with equities can expect positive stock returns if they have at least a 15-year time horizon. Past performance is no guarantee of future performance, but history has been very consistent in its conclusions so far. As I mentioned, the long term works to the advantage of equity investors. Those who can be patient with equities can expect positive stock returns if they have at least a 15-year time horizon. Past performance is no guarantee of future results, but history has been very consistent in its conclusions so far. Thank you for watching. The next part of this is the question and answer portion from my July 26, 2017 presentation. Are there any questions that didn't get asked? And I apologize if I spoke quickly. I don't want to waste your time tonight.
One question on the
Yes, sir.
Morgan Stanley slide of the effect of a 1% increase in interest rates.
Yes.
We wonder what assumption they made on the TIPS version, which it's a hybrid. It has a treasury bond plus an inflation floater. It would seem to be very, it could end up being positive as well as negative.
Potentially, but this is on average, and this is also experience of what they've seen. So even though you've got a positive coupon, as the floating rate is just about even, but it's not quite even. So the assumption that gets it to not quite even could be default rates, could be any number of possibilities. I'm not sure what they'll take into account there.
On the TIPS.
Oh, sorry, TIPS.
Yeah, the TIPS, it shows negative, it shows a loss, but at sometimes if inflation is the driver behind the interest rate, the TIPS might sell at a premium.
Sure.
For fear in this case.
Sure.
So.
Recognize that inflation, though, is not really a function of fear. Inflation is more a function of too much money chasing too few goods. So where we've had free money that's put a whole lot of extra cash into the economy, and with a slow economy that hasn't had a huge impact on inflation, if we truly do get back to more historical averages of 3 to 4%, you could see a rise in inflation. And yeah, the TIPS will look pretty good in a high inflation environment. But this is looking strictly at interest rates, not inflation. Oh, yes, sir.
What's the general knowledge on whether there's going to be a tax cut in the foreseeable future? What's the generally accepted estimate?
I think the likelihood is getting a little less.
Okay.
As we go forward. Whatever political clout Trump had when he came into office is getting eroded with some things that have happened recently, not getting health care done and that sort of thing. What was going to drive the tax cut was really going to be him. And if he doesn't have the political clout to drive it, I think it's less likely. When you look at historical income tax rates versus where we are now, we're at the low end of historical income tax rates. Lowering them would be a benefit to the economy. More money in our pockets, it's more money we can spend and generate economic growth. But at the same time, you saw the government numbers on what they're spending. That money's got to come from somewhere. They want their tax money. They're not likely to lower it without a good reason. So I think that most likely that idea is stalled for the time being. Now, they might simplify the tax code,
but they're going to do it in some sort of revenue neutral.
In the 2007-2008 bust, to me was an artificial. To me, it was an artificial government induced bubble. Do you see any other bubbles? Do you see any other bubbles on the horizon?
I would call right now, I'd call bonds in a bubble.
Okay.
I didn't include that slide this time. But there's a slide that I show where the money since 2009, even though you see the market's up 258% on the S&P 500, up until 2013, 5-to-1 margin money flowed to bonds. And then it turned around in 2013, we saw money flow to stocks, and that's when interest rates actually fell because there was less demand for bonds. Since then, money's gone back to bonds again. So if you look at the history of our recent asset bubbles, going into the late 1990s, we were dealing with the tech markets.
Yeah.
And that was driven by everybody and their brother having to replace their computers, afraid that they're not going to make it past the year 2000. Then that thesis fell apart in 2000, and people moved their money out of there. That broke apart the dot-com boom, and from there, a lot of the money went toward real estate. You had a lot of baby boomers and such that said, okay, and it was mostly the retirement places that experienced the greatest growth. Your Arizona's, Nevada, Florida, those are the places that had the greatest growth during the real estate boom. And then when the real estate markets fell apart, then the money went toward commodities. You had gold and oil and other things shooting for the roof. Those fell apart in the fiscal crisis. Since then, out of fear, money's been piling up in cash and bonds. So if you look at the flow of money is what drives bubbles. If I were to describe a bubble based on a flow of money, I'd say bonds right now are the biggest bubble because a small movement of interest rates can lose a lot of value. And people are sitting there knowing they're getting very little in the way of return for their money, with a great risk of losing money with rising interest rates, but they're happy with that because they're afraid. So that kind of irrationality drives bubbles.
Going back to this tax question, so you think the probability of the tax cut is kind of reduced for now?
It's reduced. It could still happen, yes, but it's reduced because the main driver of it is not going to have much of a driver seating.
Now, are you differentiating personal tax cuts from corporate tax cuts?
I am. I think corporate tax, that's going to happen. It's a question of how much. Again, when we've got the highest corporate tax rates in the world, that's one reason that we have so much offshoring going on. We have companies that are moving their headquarters overseas. You want to bring back jobs to America, you have to bring back those companies to America. Don't make our tax code and other things, but don't make our tax code especially so onerous. So I think you're going to see that happen at the minimum. But the income tax rates is anyone's guess. I think there'll be at least especially a token movement towards the income tax rates that'll deal more towards tax simplification. But whether they'll actually lower the rates, we'll see.
What about estate taxes? Do you have a prediction on that?
State taxes are always a bugaboo. When they get rid of the estate tax, they get rid of the step up because they want their money somehow. So and then what that means is when you die, your heirs have to be able to go back and do a whole lot of research and cost basis so they can figure that out. Generally, what you find is that politically speaking, it's hard to get rid of the estate tax that's seen as benefiting the wealthy. But you look at who it actually benefits, it benefits small businesses, farms, a whole lot of folks that end up losing their businesses and farms when next generation. So there's got to be some give and take there. I do think that we're probably going to have a fairly favorable estate tax environment like we do now, where you can pass on as a married couple 10.5% or $10.5 million without estate tax hit. I think we're going to see that type of environment going forward, at least for the time being. But I don't think we'll get back to an environment where they'll eliminate it anymore. Okay. A few things I had for you. I had the review sheets. I definitely appreciate your feedback. If I can be a benefit to you guys, that's what I do. I enjoy talking, but the real financial planning actually occurs one-to-one. So if you have any questions, I don't charge to have conversations with people. I'd be glad to sit down and just map out something for you if you'd like. On the back table, not where the food is, but the other back table, some articles I've written, my newsletter, some other sheets, business cards. Please feel free to take whatever you need. And again, at any point, if you have any questions, email, fax, or phone, I'm always available. Thank you for coming.
Thank you. Good job.
Thank you.